Hey, welcome back, traders. It's John from Rain King LLC. It's December the 8th, 2023. Time for a general market update. Again, a reminder, the presentation is for educational purposes, and I'm an amateur individual growth stock investor. So the agenda this week is we'll touch on the indices briefly, really quickly go over breadth. Then we're going to talk a little more about rotation and repositioning in the trend monitor. And then really the educational topic this week is, what do I do with my bear market losers? And we'll talk about some considerations, and then we'll wrap it up. Okay, so let's dive into the indices. Currently, the indices, and I'm recording this on December 8th around 11:30 a.m. So these slides were cut a few minutes ago. Here we are with the S&P 500. You can see we've had this sideways digestion going on, which is very constructive as we're near some old highs from July. What's also encouraging is we're getting continued new highs, net new highs, as the index is going through this consolidation. So that's a good combination on the S&P, and we're going to go a little deeper on the S&P in a bit. Here are the Qs. The Qs are also acting well. You can see we've had basically a very brief small pullback of only 2.9%. If that's the extent of it, that's really, really constructive. The Qs were currently plus 0.05%, but you'll notice that I've called a couple of more growth measures. The ARK fund was up a while ago, about 1% today, as well as the IWM. The small caps were up 0.7%. So they're actually outperforming the Qs again. We talked about potentially money coming out of the Qs and rotating. So we've had two really mild distribution days, nothing to get concerned about yet. And we're getting net new highs on the NASDAQ, which is also very constructive. So here's the stocks breaking out, the leaders plotted on the rally. Again, even this past week, we've seen some more stocks break out. GitLab had a really good earnings report and guidance. The home builders have now started to run again. DR Horton and Lennar. We talked about Pulte breaking out a few weeks ago. So good action, and these ones in light blue happen to be new issues in the past 18 months or so. So again, the picture looks good. We're continuing to get breakouts, and we still have a power trend condition, so that's really, really positive. So on the breadth, let's take a look. Just a couple of really quick charts here. On the left, this is the New York Stock Exchange advanced decline line, and the rally we had in 2023, we had a very, very hard break in the fall. But what's going on right now is really helpful because we're repairing that damage in the advanced decline line pretty rapidly, which is really good sign. Over the last, the fall was pretty bad. So this is good. It continues to improve. And then when we look at the S&P, the percentage of stocks over their 200-day moving average, that also is improving. You can see that's sharply recovered. We're back to about 64% of the S&P is above their 200-day. And what's also, we're seeing growth stocks participate, but we're also seeing cyclical stocks participate in the rally. So there's broader participation occurring. Really good sign to see this chart looking a lot better. So let's move into rotation and repositioning. So this chart I have on the left, or more of a diagram, informatics, is showing the various S&P ETF sectors and how they perform in the business cycle. So if we take a look at the business cycle, down here, this little sine curve showing, when there's a peak in activity, then gradually there's a slowdown, eventually there's a recession, the economy troughs out, eventually there's an economic recovery and a stage of expansion. Very typical business cycle. And the different sectors perform differently throughout the cycle. So for instance, number one being during a recession. This is showing since 1960, the real estate sector during a recession performs very poorly, minus 22%. And you can see consumer staples would perform well. And so you might want to pause the video player and take a good look at this because it shows you how these sectors perform during a recovery, the expansion cycle, and slowdowns. Now, it's interesting because certainly things have cooled off in our economy with interest rates rising over the past 18 months. There are people saying we're going into a recession, but there's also people saying, no, no, we're going to have a soft landing, and we might actually bridge over the creek here and get back to an expansion mode if the Fed cuts rates in 2024. So this might be an unusual situation. Some people say we're definitely headed for the trough. We'll have to see how it plays out. So with this repositioning, let's look at some of these sectors that perform well that were in a bull market. On the right here, we have the broker-dealer index, and I've mentioned before it was starting to close in on new highs, still looking very, very strong as we approach highs. The financials are very important to a bull market. They have actually made new highs and are starting to consolidate a little bit. And a couple of the economically sensitive sectors, the home builders are moving to new highs because I think they're anticipating rate cuts maybe in the second half of 2024. And XLI, which is the industrials, the cyclical stocks are performing too, really probably on the premise of a soft landing in the economy. So again, these sectors are performing well and really, really constructive. Now, also looking at this rotation that we spoke about from the Qs and the Magnificent Seven, I've taken here the Qs and I've divided them by the IWM, the small cap index. And so when you do that, when the line is heading down, that means that the Qs are underperforming small caps. So you can see since this rally began in early November, the Qs are underperforming. Then I took the Qs on the right and I divided them by the ARK Growth Fund, which is a proxy for growth stocks. And you can see that the ARK fund since the beginning of November is literally crushing the performance versus the Qs. So it's more evidence that the Qs are maybe seeing some money rotate out of them and move to other areas of the market, which actually is constructive for a broadening of the rally. Let's take a quick look at the trend monitor. So trend monitor is all looking really, really good. We're still in a power trend condition. I mentioned we've only had 2 distribution days and they were fairly mild over the past 5-6 trading sessions, and the pullback has really been benign in the NASDAQ, so really good. There are still names working, there are new issues working, some earnings gaps. Can't say it's all been rainbows and sunshine. There have been some quick snapbacks in some stocks, a couple of ads. I know I've had a couple of ads that got stopped out. We're kind of in a position of jockeying where you're trying to get your position, and sometimes you take a little ad and you got to back away from the market and take a small loss as you're trying to get more money positioned. So it's not easy, but the good news is we're still seeing setups. New highs continue. We talked about that before. We are in a power trend, which is good, and the breadth, as I mentioned, is improving. And the whole construct of the price and volume action has been constructive. We're getting good volume on up days and fairly benign down days. So this is all looking fairly good. Now I wanted to move to really the more educational part of the session. And it's all about what do we do with bear market losers? When you go through a bear market, sometimes you get caught holding a stock you bought and you still have it. And people ask all the time, well, what do I do? Should I sell it? Should I buy it? So let's look at it. So what should you do? Should you be buying more of a stock that you are holding that's a loser? Should you sell that stock or should you hold it? So a couple of statistics here. There's an IBD statistic that says that you have to realize that only a small fraction, plus or minus 17% of leaders from one market cycle will make it back to the next bull cycle. So the odds of your stock becoming a real big leader are not that high. Doesn't mean it can't happen, but they're not high. And if you're holding a loser that you held through the bear market, it can really be an anchor. It can be an anchor on you financially, the losses that you're holding, as well as psychologically. So you try to learn from these experiences and try to eliminate them by creating rules to prevent you from being in a position with a losing position. Now, of course, we all want to make back the money, but you have to think about, well, what are the considerations of how I'm going to make back the money from this losing position. So there's three situations that I'm going to go into detail about. We're going to talk about a dead money situation where you'll say the stock that you own is dead money because the future is just not bright for that particular stock. We'll look at the situation where there's opportunity cost, saying, are there better names that you might want to move the money into? And we'll look at turnarounds. Sometimes that loser stock that you have has a very bright prospect for the future, which may give you a situation where you do want to continue to hold. But they're all different, and we're going to look at these in a lot more detail right now. Now, the first question you should ask is, what is the current environment that you're in holding this losing stock? Are we in an early bull market or new uptrend? Or are we still in a bear market, in the middle of a bear market? We're at the end of a bear market. Now, we know that currently we are rallying. The market is strong in the past 4 or 5 weeks, but obviously if you're holding a loser, you're not fully participating with your portfolio. So let's look at the first situation, which I call dead money. And you say, let's look at our stock that we're holding. What is the potential of this losing stock? And a number of questions I would ask to try and consider are, is your stock that you're holding outperforming in this rally? And if you say the answer is no, it might be moving up, but it's not rallying nearly and outperforming like other leaders. Did it emerge from a base that showed actual signs of accumulation? Let's say the answer is no. Does your stock that you're holding have really good, strong earnings and sales forecasts for 2024 and 2025? Let's assume the answer is no. Are you seeing big blue volume spikes of accumulation in the charts? Let's assume the answer is no. And is your stock getting institutional sponsorship? Are institutions buying more of your stock at the moment, or are they distributing and want less of your stock? Then we look maybe at what the group industry rating is. Maybe it's still in a group that's pretty strong, or maybe it even has an accumulation distribution rating that looks pretty good. Now, in this scenario, with this combination of answers, it's probably just simply a laggard stock, and you probably should consider selling and moving on. So let's take a look at one of these. So this is C Limited. This was a huge winner in the 2019 to 2020 period. You can see here on this weekly chart, big winner. And it's possible that you thought this winner was on sale and you might have bought it, say at 120, and thought maybe you were getting a real bargain. And then when the stock rallied up to 175, you felt pretty good, saying, wow, I really got a bargain, I'm doing well. But unfortunately, the bear market gets all these stocks, and eventually the stock goes down, and all of a sudden you're in a really bad situation. You're down 67%, and you say, I'm going to have to hold the stock and become a long-term investor. So this stock, dances around. It's still now at lows. It's only at $38 a share. So we looked at these questions to ask, what are we seeing? Blue distribution spikes? No. We're seeing red distribution spikes. Clearly, this stock is not healthy. Also, we see under sales, there's material deceleration of the sales. You can see from 64 gradually going down to only 5% increase in sales year over year. Not a good picture. And we can see that funds are leaving this stock aggressively. We've gone from 1486, it got up to 1503, but over almost 200 funds have exited its stock. So clearly funds are not looking to get into this situation. This is really dead money, and you probably should consider dumping the stock and moving your money to one of the new leaders. So let's look at the next opportunity, which I call opportunity costs. And this is really looking at the same questions, and we're saying, is there a potential new name that is outperforming in this rally that I might want to move my money into? And if you say, yeah, there are stocks like that, and then you say, well, is that potential new name showing accumulation and strong earnings forecasts and volume spikes and all of these questions? If you come back with a bunch of yes answers, it might mean you found a better stock that you might want to move your money into. So let's look at the situation closer. Here is Affirm Holdings. And I put it in this opportunity cost because here's a stock that, again, if you bought it here and you're down $100 and you bought it up here and you held it all the way down, you're in a bad situation. You're down quite a bit. Even though the stock has rallied quite a bit, you're down 60%. Now, in this situation, we see big blue spikes, positive accumulation going on in the stock. We see a base that has a breakout, and we had good volume on the breakout, all positive. Then we see on the sales side, we have accelerating sales. We have funds showing renewed interest in this company. They're increasing. We have an up-down volume of 2.2, which is again showing accumulation when you're above 1. And we have a positive earnings projection forward that's greater than 30%. It's up to 70. They're saying it's going to be up to 78% as we move forward. So this is a really good situation. And I'm not advocating for any of these stocks. I'm just using a firm here as an example of opportunity cost. So in this situation, if we were to break it down and say, well, what is the opportunity cost situation? And let's look at the numbers this time. So let's assume in C Limited, you were down 50% and you originally invested $25,000, but you're down. You're down $12,500 with a loss. You decide rather than, we might want to move this money into a leading stock. And I'm using the example of a firm. So in this case, you say, I'm going to sell the losing stock. I'm going to take the remaining capital of $12,500, and I'm going to add another $12,500 to get my size up to $25,000, and I'm going to invest it in a better horse. I'm going to put it into a firm. Now, based on your homework, you believe the prospects of a firm are strong, as we showed on that chart. Now, if a firm performs and runs from 40 to 60, that's a 50% move. And you would actually gain $12,500 and recover your loss that you took with C Limited. So it's showing you that sometimes you're better off just taking your remaining capital and getting it into a better situation and recover your money potentially faster versus waiting for C Limited to hopefully come back. Now, none of this is really easy. You know, sometimes you find a new horse like this in this example that's better. And they actually are better than holding your old dead horse, such as C Limited. So opportunity cost is something to consider. Now we're going to look at one that's called a turnaround situation. So let's say you've got this stock and you've held it and it's a loser, but we answer the same questions and you say, look, this stock is really that I'm holding is starting to really outperform in this rally, and then maybe it's going to be a leader again. And all of the answers to the questions are positive. You say, yes, it's showing really strong signs. So what would this maybe look like when you consider this with that stock that might be currently a loser? So this is Shopify. Let's assume Shopify, which was a huge winner, you bought it up here at 95 and you rode it all the way down to about $23. And you just decided you're going to hold it. So you've been holding it and Shopify has been grounding higher. And you're trying to decide if you should cut it loose or you should keep holding the position, or should you even buy more? So in this case, when we do our examination, we say, well, we have a base, a double bottom base that is showing accumulation. We can see some blue spikes in the base. We can also see some big fund buying that occurred in the first half of this year. 1, 2, 3, 4 blue spikes. And we look over into the fund ownership side panel in MarketSmith, and we can see that JP Morgan has increased their position from 10 million shares to 14 million shares. We can also see that the Contra Fund had 800,000 shares, and now they've increased it to 2 million shares. So this big spikes that we saw early in the year reflect funds were moving into Shopify. So that's a very, very positive sign. In addition to that, we can also see that Shopify is showing very strong projections of earnings over the next 2 years, over 1,600%, and then the following year, another 40% growth. Very positive. And you can see that the funds have been increasing. We've gone from 1,842 funds in March, and we're up to 2,082 funds as of September's reports. And we can also see in a turnaround situation, Bill would always say, if it's a turnaround situation, he says, I want to see the numbers on the table to show that a real turnaround is occurring. And we can see sales and earnings are really picking up again. You can see that these negative quarters year over year for the past 12 to 14 months have turned around, and they're getting positive earnings at Shopify. And we can also see that the sales are still very strong. So the sales and earnings to back up this premise of a turnaround are on the table. So, and this is a situation that if you held it as a loser and you're still down, you may still consider holding this stock because you see that there's a really bright prospects around it and you believe in the story. Also, you may consider a rare situation where you may even add to the stock. So here's another one. This is Cloudflare. Again, this is another really strong stock from COVID. It was really, really good. Let's assume you bought the stock up here at 160, but you froze up and you didn't do anything and you just held it. And you got caught in the bear market and you're down quite a bit. In fact, even with the bounce that it's had over the past 6 months, you're still down 51%. And you say, what do I do? Well, in this case, let's take a look at what's going on with Cloudflare. Now, we do see a base, and that base is showing accumulation. So this is a positive feature. We see 3 or 4 blue spikes. So that's a constructive, tighter base. So that's a positive for Cloudflare. Now, if we look at the sales and earnings, we see these are solid numbers for Cloudflare, but we're going to see that the numbers are getting tougher. The comparisons are getting tougher for this company as it grows. And you can see these plus 500, plus 700 numbers are starting to come down. Now, the sales are even starting to come down from the 50s on growth in sales down to the 30s. So the numbers are getting tougher. We also look at the funds, and we can see that the institutional funds are stagnant. They're not piling into Cloudflare. It has a pretty high valuation right now. You can see the PE ratio is 200. Now, it does have good projections. It's including 242% earnings growth in 2023 and another 19 in 2024. I guess the question would be, you know, it's got a PE of 200. Is that growth already priced into this stock, or can the stock expand that PE to 250 to 300? That's a question you have to answer by digging into the numbers and looking at the company. But in this case, I'm just trying to show you that it's not easy sometimes to determine, you know, is this a stock that I would move money into, or would I hold this loser longer? It's a tough decision at times, but we're trying to give you some things to consider. So that's it for the bear market losers. Let's try to wrap up this market update. Again, really quickly, the power trend's on. Things look good and healthy. The trend's looking healthy. The leaders are up and out. And there's more names setting up, so it's all positive. I've kept the exposure levels at 60 to 85%. We're digesting here. It's difficult to chase strength in this type of situation when we're going sideways. I want to keep a little powder dry for pullback buys, but that's all up on an individual basis. You know, we're watching the first pullback. So far, the first pullback in the NASDAQ was only 3%, which is really benign and constructive. So far, the big leaders are not giving much of their gains back, and the distribution days have been mild. So again, I put these all in the plus column, but always review your positions, review your portfolio to see how much open risk you're carrying, and try to keep it in check so you don't get hit if the market goes south. So the quote of the week this week is from the legendary speculator Jesse Livermore. The trend has established before the news is published, and in bull markets, bear items are ignored and the bull news is exaggerated. You know, we've had this rally starting in November. A lot of people didn't believe it and they didn't participate. And that trend, you know, that started in November is starting to get, you know, in the newspapers and the news now, but the trend was established way before the news was published. And hopefully we'll continue to see bear items and news, bear market news get ignored, and hopefully bull market news will get exaggerated to the point of pushing growth stocks higher. So Jesse Livermore's words of wisdom. I'll leave you with that one. And The general market update's complete for this week. It's December 8th, 2023. Enjoy the weekend and have a great weekend. We'll see you again next week.